Adelaide has been one of the best performing property markets in Australia over the last 5 years. But that's exactly why you need to be careful right now. Because once a market runs like this, the gap between a good investment and a bad one gets wider. Because once a market gets attention, you don't get broad, consistent performance anymore. You get dispersion. Some areas continue to grow, others plateau, and some quietly underperform, even while the broader market still looks strong. So in this video, I'm going to break down what's actually happening in the Adelaide market right now, why the supply and demand imbalance is still very real, and then I'm going to walk you through 3 suburbs where, based on the data, I would actually be looking to buy. Let's start with the broader market. Adelaide's median price has grown from around $450,000 in 2020 to pushing close to $870,000 today. That's a near doubling in value in a relatively short period of time. Now, most people look at that and think, I've missed it. But that's the wrong way to think about property, because price growth doesn't just happen once and then stop. It moves in phases. And those phases are driven by one thing, the balance between supply and demand. So let's break that down. Starting with supply. Total listings in Adelaide are still significantly lower than they were pre-COVID. We've gone from over 15,000 properties on the market to roughly 8,000 today. So even after years of strong growth, we haven't seen supply come back in any meaningful way. And that's important because in most markets, after a period of growth, you would expect more sellers to enter the market. People take profit, they upgrade, they rebalance. But in Adelaide, we haven't seen that happen at scale. And when supply stays low like this, it creates ongoing pressure because buyers still need somewhere to live. Now let's look at the demand. Days on market for Adelaide are sitting at around 22 days. That's very tight. Vacancies are around 0.7%. Again, very tight. So what that tells you is properties are selling quickly. Rentals are being absorbed quickly, and there isn't enough stock to satisfy demand. And when those conditions exist, you don't get a market that falls easily. You get a market that continues to be supported. Now, here's where most investors make the mistake. They hear Adelaide is strong, and they assume that means you can buy anywhere and get a good result. But that's not how property works. Because even in strong markets, there's always a gap between good assets and average assets. And over time, that gap becomes very clear. So instead of looking at Adelaide as one market, you need to break it down into specific locations because that's where performance actually comes from. And when you do that properly, there are 3 areas that stand out. Each of them is different. Each of them is driven by slightly different fundamentals, but they all meet the same core criteria. Let's start with the first one, Salisbury Heights. Now, Salisbury Heights sits in what I would call a balanced growth category. The median price is around $830,000, so it's no longer cheap, but it's still accessible compared to more premium suburbs. Now, when you look at performance, this suburb has already delivered strong growth. Over the last 12 months, prices have increased by over 12%. Over 3 years, that number jumps to nearly 47%. And over 5 years, close to 80%. So clearly, this is not a market that has been sitting still. But the key question isn't what's happened, it's what's happening now. And that comes back to supply. There are only a small number of properties listed for sale at any given time. Stock on the market is sitting well below 1%. Now, for context, anything under 2% is probably considered tight. So when you're sitting below 1%, you're dealing with a supply-constrained market. At the same time, buyer demand is increasing. There are over 1,000 clicks per listing on average. So what you've got is less supply, more demand, and a market that has already proven it can grow. That combination matters. Let's layer in rental demand. Vacancy rate is sitting at around 1%, which is tight. Rents have increased significantly over time, and rental yields are sitting at around 4%. So while this isn't a high cash flow play, it is balanced. And then you look at the demographics. High owner-occupier percentage, family-orientated households, stable income levels, and that's important because people aren't just investing here, they're choosing to live here as well. And when people choose to live somewhere, they tend to stay longer, which reduces property turnover, keeps supply tight, and supports long-term growth. So Salisbury Heights is a suburb where the fundamentals are still aligned and the pressure in the market is still present. Now let's move to Blackwood. And this is a very different type of suburb. Blackwood sits in the higher end of the Adelaide market. Median price is around $1.1 million. So immediately you're dealing with a different buyer profile. And naturally that changes investment characteristics. Yields are lower, sitting at around 3.2%. So this is not a cash flow market. This is a quality, long-term hold market. Now, let's look at performance. Over the last 12 months, growth has been around 10%. Over 5 years, close to 68%. So again, strong, consistent growth. but without the same level of volatility you might see in other speculative areas. Now, the key driver here is supply. There are only around 3 properties listed for sale. Stock on the market is sitting at approximately 0.16%, which is extremely low. And when supply gets that tight, even small increases in demand can push prices higher. Now, demand itself is still strong. There are over 2,000 clicks per property listing looking at this suburb. So once again, you've got an imbalance. Very low supply, consistent demand, and a market that has already proven its performance. Now let's look at the rental market. Vacancy rates are sitting at around 0.28%, which is extremely tight. So even though yields are lower, tenant demand is not an issue. But the real strength of Blackwood comes from the demographics. Over 80% owner-occupiers, high household incomes, low crime, a professional workforce, and very minimal public housing. That combination really matters because it tells you this is not just an investment suburb, it's a lifestyle suburb. People actively choose to live here. And when people choose to live in an area, they hold on to it for longer, which keeps supply very constrained and supports prices over the long term. So Blackwood is less about getting in early and more about buying into a high quality market and holding it over time. Now, the third suburb is Fairview Park, and this sits somewhere between the two. More affordable than Blackwood, but still showing strong underlying fundamentals. What we're seeing here is a similar pattern to Salisbury Heights. Declining supply, increasing demand, tight vacancy rates, which again points to a supply-constrained environment. And that's really the theme across all 3 suburbs. Different price points, different buyer profiles, but the same underlying dynamic. Supply is limited, demand is present, and the market has already demonstrated growth. Now, stepping back from all 3, there's a bigger takeaway here. Adelaide as a market is strong, but that doesn't mean everything within it is a good investment. What matters is where the pressure sits, where supply is declining, where demand is increasing, and where people actually want to live, because that's what drives long-term performance. And if you can identify that, you're not relying on luck. You're relying on the fundamentals of the property market. Now, if you're watching this and thinking, I don't know how to identify these areas myself, that's exactly what we help clients do. We start with your position, your borrowing capacity, your long-term goals, and then we identify locations that actually align with that. So if you want help putting together a clear strategy and identifying the right opportunities, you can book in an initial strategy consultation using the link below. Otherwise, if you found this video valuable, make sure you give it a like and subscribe, and I'll see you in the next video. Thanks for watching.